The International Monetary Fund says that financial vulnerabilities continue to build up in corporate and non-bank financial sectors in some countries. Speaking at a press briefing on the semi-annual Global Financial Stability Report, the IMF Director on Monetary and Capital Markets, Tobias Adrian, calls on countries to control financial and debt risks to promote sustainable development and inclusive growth. The report also calls on decision-making bodies of countries to make efforts to curb financial vulnerabilities.
The credit cycle is maturing. Financial vulnerabilities continue to build in many countries and could amplify a slowdown. Over the past 6 months, financial conditions have been on a roller coaster, tightening sharply at the end of 2018 as downside risks to global growth increased. A dovish shift in monetary policy supported the easing of financial conditions, mitigating short-term downside risks to global growth. Yet downside risks to growth in the medium term remain elevated. Under an adverse scenario, global growth could be negative 3 years from now. This means that policymakers should take careful steps to limit the buildup of financial imbalances, even as they focus on avoiding sharper economic slowdowns in the near term. Today's report launches a new framework for the comprehensive and systematic assessment of balance sheet vulnerabilities. The analysis presented in the report shows that vulnerabilities are particularly elevated in the sovereign, corporate, and non-bank financial sectors in several systemically important countries. Furthermore, the report provides an in-depth analysis of a number of specific vulnerabilities. In advanced economies, corporate debt and financial risk-taking have increased, the creditworthiness of borrowers has deteriorated, so-called leveraged loans to highly indebted borrowers continue to be of particular concern. In the euro area, fiscal challenges remain in countries that have worries about the sovereign financial sector nexus. If sovereign yields were to rise sharply, banks with large holdings of government debt could face significant losses. Insurance companies could also face losses on their bond portfolios. In China, authorities face a difficult trade-off between supporting growth in the face of external shocks and containing leverage through regulatory tightening. Weaknesses at small and medium-sized banks, low profits and capital buffers, large unrecognized shadow banking credit are restraining new lending to private firms. Further monetary and credit support may exacerbate existing financial vulnerabilities, as faster credit growth will make it harder for smaller banks to clean up their balance sheets. In emerging markets, overseas investment run by managers tracking popular indexes have increased dramatically over the past decade. Widening the range of investors can be a positive factor for emerging markets, yet that trend leaves these economies vulnerable to a sudden reversal of capital flows in response to global trends.